Hi there. I wanted to take a few moments and give you my perspective, kind of my outlook for 2026. Share with you what we're seeing in the marketplace, and then how we're positioning the fund for both future growth and future success. Now, before I get too far into what my predictions are for 2026, I wanted to look back and give just kind of a brief history as to how we got where we are today, because it definitely has not been a linear path. So, for those that may know, we actually started the business back in 2008. At that time, I was offering individual trust deed investments to individual investors. We were really focused on first trust deed investments secured on single family homes. And the majority of our clients were buying these houses either from the bank or through short sales. They were then renovating the properties and then listing them for sale. We would match each one of the loans with an individual investor. This approach, it worked extremely well for over a decade. In fact, we successfully funded over 600 loans by around 350 million in total balance. And we were able to actually get our servicing balance up to about 45 million. But as we got to close to about 50 million under management, we found out that it was extremely difficult and inefficient to constantly be matching individual investors on individual loans. Additionally, the loans that we needed to close had to close very quickly. So it was really difficult to constantly be matching up investors. And then as loans paid off, it was tough to then recycle that investor capital into another loan quick enough. So the investor had to sit on cash for a period of time. So about 2020 is when we decided to move to a mortgage fund structure. The mortgage fund structure offered a number of advantages for our investors. The most meaningful benefits were more on the tax side. So individual investors could participate in that 20% QBI tax deduction. Out-of-state investors weren't subject to California withholding tax. Investors that were investing out of their IRA were not subject to unrelated business taxable income. We were also able to add the mortgage fund onto the Charles Schwab and Fidelity platform. So if you were an IRA investor, you can now invest through Schwab or Fidelity. You couldn't do that with individual trust deeds. So kind of fast forward to today. We've now funded nearly $1 billion in private money loans, and we have grown the portfolio from 45 million to over 145 million. Additionally, we've raised over 125 million for the fund in just 4 years. Now, I can attribute to a lot of this success, obviously, is to our discipline in terms of the types of loans that we fund. We still focus on first trust deeds, loan-to-value ratios at or below 65%, and we're aligning ourselves with seasoned real estate investors and operators who have real liquidity, real cash in each one of these transactions. Secondarily, we've created a very transparent and communicative platform to our investors. So constantly updating you, the investor, as to where our focus is. So what do I see in 2026, and how is our focus or our strategy going to change? Well, one of the biggest shifts that we've seen, and we've actually seen it over the last decade, but really the last 24 months, has been the increased presence of institutional capital. In many ways, this has been a positive development for this industry. It's raised industry awareness and standards. It's brought sophisticated underwriting, fund management practices, accounting practices to what used to be kind of a mom and pop shop or industry. And so it's really raised the awareness of this asset class. The downside is it has brought in increased competition. And with that has resulted in higher loan to value ratio, especially for fix and flip loans. Underwriting standards have really kind of loosened, and it's been more and more difficult to compete in this space. Now, one of the things that we have been able to do, and especially we focused in 2025, is to shift more to traditional bridge loans. And bridge loans mean that there's no real construction risk or a value add risk to these loans. So we're not building and underwriting to future values. Now, the other thing that we've really focused on is building our broker network. So we've traditionally been direct to borrower, which is great because the communication is there. But you're really limited in the term in the number of loans that you are actually looking at. You can imagine any one borrower is only going to have one or two loans at any given time. If you flip that over and get that broker network going, you can see a tremendously higher number of loans. In fact, if you were to look in December of last year and you were to look at the number of loans we funded through brokers, it actually for the first time surpassed over 50% of the loans. And that's simply because the broker community has a lot more loans that we can take a look at. Now, the downside about working with brokers is that you really have to have your lending guidelines in place and be able to communicate that to the broker network because you want to make sure that they're bringing you loans that meet your specific guidelines. Additionally, you really have to be on top of your underwriting. You have to ask the right questions because brokers have a tendency to be able to make the loan meet your guidelines. So that's something that you really have to be able to focus. So you really want to align yourself with very good brokers, honest brokers, and then obviously really focus on your underwriting guidelines. So those are the two kind of main adjustments that I think we're going to see going into 2026. Now, the third kind of thing that we should look at is kind of where the housing market is, being that about 75% of our portfolio is secured on either single family and multifamily properties. We want to be comfortable that the housing market is going to remain strong and also the rental market as well. Now, if I were to look at the markets that we generally are funding in, so we're looking at San Diego, Orange County, LA, Bay Area, both the housing markets have remained stable. Now, you've not seen kind of the historic growth that you've seen in prior years, especially in 2025. You've kind of just seen a stabilization in the market. I anticipate that happening in these markets in 2026. Obviously, if there's some big economic shock that I don't anticipate, that might impact housing, but I don't see interest rates really moving anywhere. And I think this idea that interest rates are really driving people's reasoning for buying houses, it's not that. I think it's a supply issue. There just isn't enough of a supply, even though you are seeing a little increase in supply in some of the markets that we're landing in. It isn't really there to make any meaningful change for potential buyers. Now, there are parts of the market or parts of the country where housing prices have definitely come down. Markets, especially in Arizona, in Texas and Florida, where you see some overbuilding in those marketplaces, where you probably saw a run up in prices, and now they peaked, and now that they're starting to come down. You're seeing a lot of that in some submarkets in Florida. Now, that's another reason why we've really kind of tried to tack away from your fix and flip and your new construction, is because not only are you getting higher loan to value ratios that you're having to compete with, but you're also having to, you're coming into a market that has stabilized. So if there's any issues with a fix and flip or construction loan, it's really hard to extract yourself out if you've got a market that is declining. So that's the other reason why we really kind of shifted our focus to do more conventional bridge loans. The other reason we're doing more conventional bridge loans as well is because just the amount of investor capital in our fund has grown, and that's allowed us to do larger loans. Where if you were to look at prior years, our focus has really been kind of loans in the million to maybe to 2 million mark. You don't want any one loan to make too big or to have too high of a percentage of your entire investor capital. Now that we're north of 100 million, we can focus on loans between that kind of 2 to 5 million mark. And what's great about that is there's just less competition in that space. It's too big for kind of that individual investor, and then it's too small for the big institutional bridge lenders. So that kind of 1 to 10 million space is a great market to really focus on. Additionally, what's nice about the bridge loans and that 1 to 10 million mark is you can really focus on loans kind of in that 50 to 60% loan to value ratio versus, again, where fix and flip and new construction, you're having to go significantly higher in loan to value. So those are my predictions for 2026. What is that going to result in returns? I think we've seen what's going to happen with returns coming into 2026. Mid-2025, we saw returns peak and have come down, where we ended the year kind of in the mid 9% return. I think we're going to be closer to the mid 8% return for 2025 or 2026. I think that's kind of when we're pricing loans out based upon the competition, what we're seeing competing lenders pricing loans at. I think that's kind of generally where we're going to be able to price our loans at. So hopefully this gives you a little insight into what to expect in 2026. I do anticipate, though, to continue to grow the fund. We are still actively raising capital. We're still looking to actively increase the size of the fund. And then obviously we're just super excited to be in our new space. As you can tell behind us, it's much larger, gives all of our team members much more room to operate, and it lets us be able to expand and scale into the growth. If you're interested in learning more about the fund or some of the ideas and topics that I talked about today, feel free to reach out to me or my team. I'll go ahead and put our contact information in the description below. And if you're interested in investing in the fund, again, feel free to reach out. I'll go ahead and send you a link. Thanks for taking a moment to watch, and Happy New Year. And hopefully you have a great year. Thank you.